Welcome back to Positions Taken, where every call was backed by data, not noise. Let's break it down. SoFi just posted one of its best quarters ever, revenue up 43%, net income more than doubled, and the stock fell over 12% on the news. Over the past 3 years, SoFi's earnings per share has grown 99% a year on average. Its stock price? Just 49% a year. That's a massive gap between performance and reward. This is our investigation into why. Let's start with what actually went right. In the first quarter of 2026, SoFi brought in $1.1 billion in adjusted net revenue, up 43% year over year, beating estimates by 3.6%. Net income hit $167 million, more than double the prior year. Adjusted EBITDA reached $340 million, up 62%, at a 31% margin, the company's fourth straight year clearing that bar. SoFi added a record 1.1 million new members in the quarter, pushing total membership to 14.7 million, up 35%. Total products reached 22.2 million, up 39%. Lending revenue, the company's core engine, jumped 55% to $642 million. By almost every operating measure, this was a great quarter. So why did the stock fall? Reason 1, a short seller report. In March 2026, Muddy Waters Research published a report describing SoFi as running on aggressive, unsustainable financial engineering and alleged over $312 million in unrecorded debt. SoFi called the report factually inaccurate and misleading and said it would explore legal options. CEO Anthony Noto responded by personally buying $500,000 of stock shortly after. Even so, by the end of March, SoFi had already fallen nearly 53% from its late 2025 peak. Reason 2, a real weak spot inside the business. SoFi's technology platform segment, the part of the company that licenses its financial infrastructure to other businesses, which management compares to Amazon Web Services, saw revenue fall 27% year over year in Q1. Part of that decline traces back to losing a major client, reportedly Chime. One analyst called the concerns around this overblown, but the number is real, and it's the one line item growing in the wrong direction while everything else accelerates. Reason 3, and probably the biggest one, guidance. Despite the record quarter, SoFi's management left its full year 2026 revenue guidance completely unchanged, still targeting around 30% growth to roughly $4.66 billion. After a beat that strong, investors were expecting an upgrade. Getting flat guidance instead was read as a caution signal, and it's widely seen as the single biggest trigger for the post-earnings sell-off. Reason 4, valuation. Even after falling roughly 30% year-to-date and over 50% from its peak, SoFi still trades at somewhere between 41 and 48 times trailing earnings. That's a premium multiple for a consumer lender, and it means the stock has very little room for error. Any wobble in credit quality or growth gets punished hard. There's also a credit question hanging over the stock. Some analysts have flagged a rise in charge-off rates, plus SoFi's reliance on private credit partners like Blue Owl Capital and Sixth Street, who help fund loan originations. CEO Noto has pushed back directly, telling analysts that demand from those partners is actually running above their contractual obligations. Wall Street is genuinely split here. One bank's analyst said the market would hate these results, but that downside from here looks limited, while other estimates put fair value as high as $26 to $27 a share, well above where the official consensus target sits. So here's where that leaves us. SoFi, the business, is executing at an elite level, a rare combination of 40% plus revenue growth and expanding profitability in Fintech. SoFi, the stock, has been treated like a company with something to hide, thanks to a short seller report, a shrinking side business, and a guidance decision that spooked the market at exactly the wrong moment. The next real test comes July 28th at SoFi's Q2 earnings call. If management finally raises full-year guidance this time, that flat guidance overhang could lift, and sentiment could shift quickly. If they hold flat again, expect more of the same skepticism. Great fundamentals and a struggling stock price can absolutely coexist. This is one of the clearest examples in the market right now. Not financial advice. Do your own research before making any decision here. If this breakdown helped you understand the disconnect, like and subscribe. We dig into stories like this every week.